Well, let's discuss what happened on Friday and look ahead. We're joined by Thabi Leoka from Argon Asset Managers. Great to have you with us. Thabi, how did you feel when S&P released their review on Friday?
Very relieved, but expected, and the market also reacted in a very expected way. So the market didn't react to the outcome of the review, and that's because they expected a downgrade in the local currency, but not a downgrade in the foreign currency, which would be catastrophic.
The sovereign rating is linked to that foreign currency, and like you say, it's much less serious. The local denominated debt, those bonds are rated higher. They came down a little bit, but they are in fact linked, right? There would be a sentiment offload because government keeps on saying, oh, but we borrow in rands mainly, so it's not that serious, but there would presumably be an effect.
It is serious because I think about 90% of our loans are in rands and about 10% are in foreign currency. And what that means is that S&P did say that they are concerned about our financing in local currency. So, and we're just really one notch above a sub-investment grade. So if they do, then, they've put us on watch. And if they feel that we haven't satisfied their requirements, then the next move is down.
What do you make of their reasoning for not moving the sovereign, the foreign rating, but moving the local? We've seen in the others a lot of increased rhetoric around our politics.
Yeah, I mean, over the years, actually since 2012, when S&P first downgraded us since 1994, they did say political uncertainty. At that time, it was after Marikana, so, labor was quite an issue. But they keep saying the same things, and we still are not satisfying the rating agencies. So political instability and the fact that now the risk is that politics could actually affect policy implementation, which then affects growth. And that's what we are seeing somewhat. So growth is quite weak. They're concerned about that as well. On the local currency versus foreign currency, but I think their concern is especially on our SOEs, and they've mentioned that quite often. And a week before the review, they downgraded Eskom. And now Eskom is sub-investment grade, which means that it will be very difficult for Eskom to raise a bond internationally, and their debt servicing costs will be higher. But also that means that Eskom is increasingly reliant on the government for funding.
And that is a problem that continues, and we're going to go into next year still hovering just one grade off junk. Do you think the inevitable has been deferred, or can we in fact turn this around?
I think reform, which is what they've also highlighted, takes a very long time. If you look at any country, from Brazil to even Chile, it takes about 5 to 10 years to turn, the economy around. And if we haven't done it when we should have, and that's, I think, when we launched the National Development Plan in 2012. So we should have actually started then, and we should have actually seen progression since then, but we haven't seen much. And now to expect major change in 6 months will be very, very difficult. I mean, there's a little improvements that we've made. We now have that commission of wages that put out a minimum wage, and I think S&P was quite satisfied with that. And we also have better dialogue between Labour, government, and business, and they seem to also be satisfied with that. But we need to do more tangible things. We need to reform education. We need to reform Labour, and we need to also start seeing growth. But we're not doing what we need to do.
So basically, this is going to be very difficult to turn things around in 6 months' time, which is basically our deadline until the next review.
Unfortunately, it's a matter of we have to treat it with great urgency. I mean, if it's not June, then the anxiety starts again, and it's December. And I think our politics has not helped. I think throughout the year, we've done a lot to actually try to get downgraded from the political side. And there's only so much that the National Treasury can do, and especially the Minister can do.
Well, the Finance Minister, I spoke to him recently, and he said what is certain in his mind is that the politics has not led to a change in policy. You were talking about that. That the financial policies, the path we're on is certain. Do you agree with that?
I think he was being very diplomatic, especially because he was at the center of the investigation, the Hawks investigation, and that investigation resulted in the rand weakening, and a lot of investors were uncomfortable by uncomfortable about what was happening in South Africa. And so if, for instance, this continues, if we see another 9/12, and I'm very anxious about that date, a few days to go, but if we see another 9/12, or if something else, cabinet reshuffle that doesn't make sense, then it does impact on policy implementation. We don't want to have new ministers, especially in critical positions, coming in at a time when we have 6 months to actually try, to make meaningful change.
So it is the end of the year, but like you say, still lots could happen. And we saw Italy, that referendum, the interest rate hike probably in the US still to come. So this could still be an interesting December.
Still is, December, if you remember last year's December, the same thing happened. The Fed hiked, hiked rates, and the currency weakened, and then we had Nenegate. But hopefully we won't have a situation like Nenegate, but we do have the risk of the Fed and the reaction of investors to emerging markets. So we could see outflows as a result.
And an interest rate hike is expected, though. So again, will we be saying not much market reaction, or could this have serious implications for South Africa before the end of the year?
I think that we could see the currency weaken somewhat, but it is relatively, it is priced in. The market is expecting the US to hike rates. And when that happens, investors tend to pull out their money out of emerging markets into more less risky assets like the US. But then we start seeing that coming back in January.
Finally, something that the rating agencies have spoken about, of course, is growth. So are we looking at 1% or so coming out in those GDP figures tomorrow? Because that's important as well.
My forecast is actually 0.3%.
Sure.
So, and I've seen a range of analysts' forecasts. They range from negative to about 1%. So, which is still very weak. I think, I expect GDP for this year to be 0.3%, slightly lower than the SAB, which is at 0.4%, and I think that is what the IMF has. But that's very weak, and next year I expect a 1% growth. But still, going from a 0.3 to 1% needs big sectors to start growing. And right now, I think that the reason why you will see a decline from 3.3% in the second quarter to about 0.3% is because mining and manufacturing will underperform.
All right, and this is nowhere near where we want to be, given the unemployment rate, given these swords hanging over our head by Fitch and S&P. Both have us just one notch off junk with a negative outlook, meaning that the next 6 months, as Thabi Leoka says, are crucial. Thabi from Argan Asset Managers. Now, a referendum in Italy sent the euro to a 20-month low this morning, but markets have since shaken off concerns about the outcome of yesterday's vote. Italian Prime Minister Matteo Renzi announced his resignation after the vote for constitutional reform.